The yen is still the cheapest funding fuel in the G10 universe. Japan just did something they have never done before, moving toward an outright consumption tax cut, and yet here we are, watching US dollar to Japanese yen stall at 160.21, down 14 basis points, with a 1-hour chart that has shifted to a strong sell. If you think this is just another quiet Asian session, you are walking into a trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm giving you 3 exact levels you can trade today, complete with stop losses and risk-reward ratios that are institutionally calculated, not guessed. Right now the market is in a session fade. The higher time frames, monthly, weekly, daily, all scream strong buy. But the 5-hour has flatlined to neutral, and the 1-hour has flipped hard to strong sell. This is a textbook compression setup. The trend is still your friend on the daily, but the intraday structure is flashing a warning. The single invalidation level you must write down is 160.15. Write this number down. If we break and accept below 160.15 on a 4-hour candle close, the entire short-term structure resets, and we are targeting 159.71, then 159.15 without hesitation. The herd right now is overwhelmingly long, still riding the carry trade, still treating the yen like a punching bag. And that is exactly why a shakeout below 160.15 would be violent, because the liquidity pool sitting just under that level is a magnet for stop hunts and liquidations. Now let's walk down the chart from the weekly all the way to the 60-minute, because this is where the real story lives. On the weekly time frame, price is perched well above the 200-week moving average at 156.31, and that is the line that has defined multi-year trend health. Every time we have tested that zone in the last 18 months, buyers stepped in aggressively. The weekly MACD is still printing higher histogram bars, no divergence there, and the ADX is at 47.5, which tells you this is a rocket trend, not a slow drift. But that strength also breeds complacency, and complacency is what gets you trapped when an intervention headline drops out of nowhere. Drop down to the daily chart. Price is hugging the 5-day moving average at 160.26, while the 10-day sits at 160.14, so we are literally trading on a knife's edge between the 5 and 10. The 20-day moving average is much lower at 159.80, and that is a vacuum zone if the floor breaks. Daily RSI is at 57, not overbought, which means there is room to run higher, but the stochastic at 62 has started to curl, hinting at fading momentum. The daily MACD line is still positive at 0.37, but here is what most traders miss. Look at the 4-hour chart. Price made a swing high near 161.03 resistance, and the 4-hour MACD histogram is already printing lower highs while price flirts with that same region. That is a textbook hidden negative divergence. Buyers are exhausted, and the smart money is using this strength to distribute into the retail bid. Now bring it down to the 60-minute battlefield. The 1-hour chart is already in strong sell mode, with the 5-period moving average crossing below the 10 at 160.26 and 160.14. The price is currently hovering right on S1 support at 160.15. with S2 lurking at 159.88 and S3 at 159.71. The pivot point for today is 160.32, and we are trading below it, which gives the intraday session a negative bias. The ATR is 52 pips, so expect a 30 to 50 pip range expansion once the London or New York session kicks in. Williams %R is at -30, not yet oversold, so there is still room on the downside before a snapback. And the CCI at 79 is tipping lower. This is a coiled spring. If 160.15 holds, we see a sharp mean reversion back through the pivot toward a 1 at 160.59 and a 2 at 160.76. If 160.15 fails, the trapdoor opens, and we accelerate toward S3. It is that binary right now. You cannot trade this asset without understanding the intervention ghost. It never leaves the room. The Ministry of Finance has drawn a line in the sand before around these levels, and verbal intervention has already started percolating in Japanese media. But here is the new fundamental driver that changes the calculus. Yesterday's news that Japan is moving toward its first-ever consumption tax cut is a seismic shift. The market initially reads this as fiscal stimulus. More spending, more JGB issuance, a weaker yen. And that is the reflexive sell you are seeing in yen crosses. But dig deeper. A consumption tax cut in an economy already operating with negative real rates can reignite inflation pressure, the very thing the Bank of Japan has been trying to engineer sustainably. If inflation overshoots because of this fiscal impulse, the BOJ is forced to tighten further, and that breaks the carry trade from the inside out. So the 1 to 2 week directional lean is this: I am cautiously bullish while 160.15 holds, targeting a retest of 161.03, maybe 162. But if we get a confirmed intervention statement or a sudden spike in Japanese government bond yields, the unwind will be brutal and swift, dragging this pair to 158.50 in a matter of sessions. The exact event that invalidates the bullish lean is a daily close below 158.50. That is your structural backstop. I want you to comment right now. Do you think the dollar breaks 162 this week? Comment yes or no. I'm tracking consensus across this channel. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to hand you 3 concrete trade strategies, with exact entries, stops, targets, and the logic behind each one. No vague zones. No hand-waving. This is a real plan. Strategy 1 is the sniper, the conservative play. We are waiting for the market to come to us. The entry condition is a limit by order at 160.15, but with a confirmation filter, we need to see a clear bullish rejection wick on the 1-hour candle, closing back above 160.15. That tells us the trapdoor held and the stops below got swept clean. Stop loss is at 159.85, just below the S2 level and the 20-day moving average area. That gives you a tight, logical invalidation point. If price goes there, the structure is broken and you do not want to belong. Take profit 1 is 160.59, which is the R1 resistance and today's pivot magnet. Take profit 2 is 161.03, the triple resistance ceiling and a zone where you absolutely must take partial or full profits. The risk to reward on this setup is 1 to 2.9 with a 30 pip stop and an 88 pip target too. This is a high probability, low stress entry that lets you sleep at night. The invalidation note: the entire trade is void if we get a 4-hour candle close below 160.15 before the entry triggers. That is your simple filter. The sniper, conservative. Entry: 160.15 on 1H bullish rejection close. Stop loss: 159.85. Take profit 1, 160.59. Take profit 2, 161.03. Risk, reward, 1:2.9R. Invalidation: void if 4H close below 160.15. Strategy 2 is the active trader, the standard play for those who want to engage with the intraday momentum but still respect the higher time frame trend. The entry condition is a break and retest of the daily pivot at 160.32. Wait for the 1-hour candle to close above 160.32, then look for a shallow pullback to the 160.35 area, the pivot acting as support now, and enter long with a market order on the bounce. Stop loss goes at 160.10, just below the psych round number, and ahead of S1, giving your trade room to breathe without getting caught in the noise. Take profit 1 is 160.76, just inside A2, and take profit 2 is 161.03. Once take profit 1 is hit, immediately move your stop loss to break even at 160.35. That trailing rule locks in a risk-free trade and lets you ride the runner. Risk to reward initially is 1 to 2.7. The setup is void if price drops back below 160.15 before your entry triggers, because that would indicate the pivot break was a fake out. The active trader, standard. Entry: 160.35 on 1H close above pivot and pullback. Stop loss: 160.10. Take profit 1, 160.76. Take profit 2, 161.03. Risk, reward, 1:2.7R. Trailing rule. Move SL to 160.35 after TP1 hit. Invalidation. Drop below 160.15 before entry. Type your US dollar to Japanese yen range for tomorrow in the comments right now. Let's see who is aligned. I read these and it sharpens our collective edge. Strategy 3 is the aggressor, a high-risk counter-trend scalp for those who can manage small losses and react fast. This is not for everyone. We are looking to fade the intraday rip into resistance, targeting the reversion back down to the pivot or deeper. The entry is a limit sell at 160.75, right at the R2 level, and we need a bearish divergence confirmation on the 15-minute chart, a lower high in RSI or MACD while price tags that 160.75 zone. Stop loss is razor thin at 160.90, above the R3 ceiling at 161.03, giving you just 15 pips of risk. Take profit 1 is 160.32. The pivot, and take profit 2 is 160.15, the S1 trapdoor. This delivers a risk to reward of 1 to 4, 15 pips risked for a potential 60 pip reward. But the warning is explicit. This is a counter-trend trade against a raging daily bull. Only take it if you see clear exhaustion and you can accept a full loss on a sharp intervention headline that spikes the pair. If a 1-hour candle closes above 161.03, this whole aggressive play is dead and you cut it immediately to the aggressor, high risk. Entry. 160.75 limit sell with 15M bearish divergence. Stop loss. 160.90. Take profit 1. 160.32. Take profit 2. 160.15. Risk, reward. 1:4R. Invalidation. 1H close above 161.03. Risk management is the foundation. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events unless you are hedged and fully aware of the consequences. Stops are non-negotiable. They are not suggestions. This is how you survive to trade the next big move, and the next one, until your compounding turns into something unstoppable. So here is your single most critical level for the next session, 160.15. That is the line that separates a controlled bull flag from a liquidation cascade. Tomorrow I will be zeroing in on the Tokyo CPI release and any fresh verbal intervention from Finance Minister Suzuki, because that combination could generate a 100 pip range before most traders even wake up. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and it takes you straight there. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.